Hi, my name is Andrew Masters and welcome to FIBO Group, and I'm an analyst here. This video will talk about the Forex market behaviour and transaction opening rules. There are only three possible scenarios in Forex. You either buy, it's all called a long position, or a sell, open a short position, or you do nothing and wait for the right moment. Based on this, one trader buys and another one sells at the same time. And that is why the competition begins as well as all these leaping price movements. This competition is called a competition between the bulls and the bears. A bear is a trader selling for a fall. A bull is the one who buys for a rise. And so is the life of these two irreconcilable forces in the Forex market. Let's go back to the origins and think of the most important rule of any market. It's to buy cheap and to sell expensive. So we had a pound-dollar chart. For some reason, we decided to buy here. At the moment, the price was 146.10. The price fell slightly and then began to move in the direction we needed. You decided to close the transaction, and in a month, on May 27th. At that time, the price was fixed at 159.60. We would earn 1,350 points in total. Income in points is a very abstract notion, so let's see clearly how much we would earn in US dollars. Our income expects on a certain basket of factors, including the amount of deposit. Let's consider the case where you are trading your own funds. You have $1,000 on your account, and you just closed the transaction and a profit of 1,350 points. Your profit makes 13.5% and you'll obtain $135 of income. If you had $5,000, your income would make $67. Well, and if your deposit made $10,000, you would earn $1,350 US dollars. Of course, you cannot always make a profit. There are certain costs in the market. So your costs would make $10 if your deposit were $1,000, and they would make $50 if your deposit were $5,000. If the deposit were $10,000, the cost would make $100. Your income is much higher than the cost, and this is both pleasant and correct. Of course, everything depends on what lot you start the transaction with. For example, during the calculation of income, when you trade your own funds, we use the 0.1 lot for the transaction opening. You have not dealt with this concept yet. Now I'll explain to you the meaning of this term. Lot is the amount of an asset, the transaction multiple of this minimum lot, operated by the broker at the client's direction. In fact, this is the amount of currency he's ready to open the transaction with. The value of lots is calculated differently in different currencies. It's up to the broker to calculate exactly how much it will cost for you. Let me provide an example. Let's take the dollar-yen pair, a standard lot. This is one lot for this pair will equal to 100,000 US dollars. If we talk about a mini lot, 0.1 lot in terms of figures, it will be equal to 10,000 US dollars. There is also such a notion as a micro lot. It's equal to 0.01 lot. This is 1,000 US dollars in money terms. So you have already decided what lot you will trade with. You decide whether to buy or sell the chosen asset, i.e. the transaction direction. Later on, you need to place an order for a specific type of transaction, i.e. the purchase order or sales order. Speaking in a scientific manner, the order is a directive given to the broker to operate the transaction with a certain amount, and the exchange rate, there are immediate execution orders and pending orders. Immediate execution orders are those for the purchase or sale of an asset at the currency according to the current marketplace. Pending orders are the bids for purchase or sales of an asset at a desired price. A specific feature of those orders is that it's not necessary that the price will reach this point. However, you will not miss a profitable transaction for sure if you have no access to the computer. In the next video, we'll learn how to open transactions and to use the leverage. Stay with us.